All right, so we got the FOMC minutes and some JOLTS numbers out today. Those are really important employment numbers and the Fed's thinking. The market didn't really respond too much to it. It's still got its eyes on the employment number here at the end of the week, and then the inflation data due out next week to see what they should, to get an idea of what the Fed's going to do at its next meeting, which right now is very highly probable they're going to hike rates another 75 basis points. So we're going to talk about that, break this down. Just a quick heads up. I'll be leaving out of town on Friday, so we won't have a market outlook on Friday or all of next week. So I won't get back until the following weekend. So the next time I'll do a market outlook video will be on the Monday, the 18th. So you'll be able to, if you're wondering where the videos are, keep that in mind. Brandon will be out next week as well. So I believe next Thursday he'll be gone from doing his video. So by the end of next week, I don't believe there will be a market outlook video Wednesday, Thursday, or Friday until I get back from our vacation. Like I said, that following Monday on the 18th. So this will be my last one for a little bit more than a week. So however that impacts the markets, you have been warned and you may prepare based on past precedent. Hopefully it won't be too drastic this time. We can all just kind of take a vacation and nice summer slow week and a half and be able to come back on the 18th strong again heading into the FOMC. Let's go ahead and get started. Today is Wednesday, July the 6th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel, like our video down below by clicking that thumbs up icon, comment on the video, join our website at MarketScholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe for free. Follow me on Twitter for more content between the videos and join our Market Outlook Facebook group that we've created. If you're watching this here on our blog, come down here, click on that heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. Opens up another new tab. Hit that like button there as well. Again, the more you do that, it helps get our content out to more of our followers. It also helps you be able to make sure you see all of our content because of how these algorithms work on their platforms. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. So we had a nice good rally. We're back above these two lines right here. These two Fibonacci lines are both off of rallies, right? The black line is off the post-COVID low point rally, and then the red line is off the post-2009 low point rally. So really long term. So we're really flirting with a big long-term, couple big long-term support levels. That's why we're kind of flirting in this area. You've also got this green and brown lines, which are based off of these current declines. We're on the current intermediate decline as well as the market sentiment decline. These two back-to-back intermediate declines that we've been on. So those are the resistance levels that we're facing. We're not getting very big ranges, getting very big volumes. The short-term sentiment did rally, though we came off of the high today a little bit. So the momentum line pulled back down. It was actually up like it was yesterday. It was actually even further into extreme levels, but they were both at extreme levels yesterday. It's a good sign. Market sentiment is rising, though it's still below 20. Remember, it's very rare for market sentiment to get below 20. And the intermediate line's rising again, though it's still in bearish territory, so it hasn't quite crossed out there. We're still below the 30-day moving average. We're less than 2% below, though, which is, again, not as bullish or bearish, excuse me, as we can be. The NASDAQ 100 is actually pretty good, too. It had pretty decent short-term sentiment here, getting up to above the 90th percentile. We're only less than 1% away from the 30-day moving average. Its intermediate line is also rising. Market sentiment's even deeper, but it's also rising in bearish territory. Its 30-day moving average is starting to rise. So, unlike the S&P, whose moving average is still falling in red there, that's why it's still red over here. See, it's still red. That's not the case for the NASDAQ. So NASDAQ's been converging a little bit more, almost a little bit of a kind of a head and shoulders double bottom type consolidation pattern here. But you see that its moving average is actually yellow, which means it's turning up. We're below the moving average, but it's turning up. So that's how close we are to getting, again, potentially dark green shading and a green line on the NASDAQ 100, which would be a bullish pattern. The Russell 2000, we are actually further. We're still 3% below. Its intermediate line still declining. It had pretty decent bearish sentiment, but we're still pretty bear. Remember, we're well below the these two. Remember we're flirting with these two lines on the S&P to 23 and 38. We're well below that on the Russell. And for that matter, we're also well below that on the NASDAQ 100 too, right? So there's those same two lines that we're kind of flirting with on the S&P. We actually got back above it on the S&P. That's how far below we are right now on the NASDAQ 100. So that's what our market forecast is showing. So it's still like we came off of what could be considered a bullish near-term low. It's not, it did get a little deep into oversold territory. You don't like it to get that deep, but it didn't stay down for very long, and it produced a higher low. It was higher than the last near-term low, and the last near-term low actually produced a cluster on the S&P. So you can see that right now we're forming a near-term high. It's not a higher one yet, so it's really important that we break through this 30-day moving average and get to a higher one. We can follow up a higher near-term low with a higher near-term high, and then move to an intermediate trend. So it's really important we do that. We haven't done that yet on the NASDAQ either, so that's how far, but you can see how bullish it would be if we were to get there. And then the Russell, same thing, we're still below. So we're forming higher near-term lows, but we're still not quite at higher near-term highs yet. So something to watch for. It's interesting, we haven't had very big moves here lately. I tweeted this out. For those who follow me on Twitter here, I tweeted this out that it's actually been a relatively, let's see here, it was earlier today, right here. It's actually been a pretty quiet, out of the last 7 days, we've had 5 days where we didn't close outside of the 1% range. We are barely outside of it on that one day. And then we had actually a 2% loss on that day. So, we're talking the last 7 days. So, 1, 2, 3, 4, 5, 6, 7. These 7 days right here have been relatively quiet days. But you notice we're still easily above 25 on the negative indicator. And we're just barely crossing above 20 on the positive. And we're below 20 when we were at the lows of the day today. So, again, you can see, we are relatively neutral. The RSI is in the neutral range between 40 and 60. The CCI is between 0, negative 100 and 100. So they're both in neutral territory. The Bollinger Band is right near its midpoint, and the bandwidth is really starting to fall down. So, that you can tell that we're slowing down the moves. The Ichimoku cloud, it's actually still showing a bearish trend, though it's very weak. It's got to be below -2 and above 65 for it to be an intermediate trend strength. And right now it's very, very weak. It's just barely below -1. It's barely below -1, and it's barely above 50. So that's weak. It's still bearish. We're still below that blue line. The red line here, which is the price plotted 26 days back, is still lower than where it was 26 days ago. So we're not, we don't have a bullish or rune crossover yet. But the red line is dropping, but we haven't got the spike to 100 there. You look at the, what was it? The McClellan oscillator. We're not getting a lot of breadth to really push us through like we did on this move. We actually did get above positive 100, but we never have gotten below -100. We are potentially here forming a higher low point on the McClellan oscillator. That would be a divergent low. It would be a positive development there. And then finally looking at the whole moving average, you can see, we have reversed back to the upside. So we're back to the 3 things that make you bullish, right? A green hole indicator, a bullish candle, and the parabolic SAR down below. So we'll see if that continues to play out going forward as to whether or not we'll continue to be bullish there. But we did close today's close. The MACD is in this case between the price and the 200-day hull is actually still above its moving average. They're both rising. We did close above a couple of days high points with today's Hakinyashi close. So we'll see if we can follow through with that with another good bullish close tomorrow. We kind of need a good breakout day tomorrow to kind of sustain this rally that we've been on. You also see too, when you look at the Bollinger Bandwidth with the Keltner channels, you can see we've had some negative momentum, and that negative momentum, we're still, I mean, the Keltner channels are still way inside the Bollinger Bands. So the Bollinger Bands are kind of, you know, shrinking here. I think before we get the breakout with the green dots, but in the bullish direction, kind of like this, right? Before we get this bullish breakout with maybe a breakout up above the Bollinger Bandwidth and up above the Keltner channel, you're probably going to have to get some red dots, which means the bandwidth comes back in the Keltner channels, and we're probably going to flirt, you know, come back to a, you know, a small hump and then turn back down to another negative momentum. That's kind of what I'm expecting. I'm expecting we'll still get some bearishness here. It's a nice rally. We were unable to get above the 17-day moving average. We're in convergence mode. The MACD is above its moving average. They're both rising, but the histogram is falling. It's already peaked and it's falling, and we're still below the 17-day moving average. So we're not, you know, that's why we're not really strongly bullish, but it also means, you know, that's why we're not really that bearish either. But if we were to get back below the 8-day, get back below this black line, stay down there, because you see we've done that the last few days, but we've rallied each day. If we were to stay down there and get that MACD to cross back over and get a red bar, then you can see how that would be bearish there. Even from a long-term standpoint, we still are not, you know, this, we're only, you know, a couple days in. We still got a couple days left. We're still way below the 8-week moving average, still way below the 17, and the MACD, it does appear that the MACD may be bottoming out here, but we're not crossing up above. We're not crossing up above that moving average yet. Remember, I showed you previously the, you know, how far below the 17-week moving average we got a few weeks ago was one of the deepest drops that we've seen in a while, right? And that typically leads to a washout move. It might not lead to the actual low point, but that deep, you know, we were over nearly 12% below the 17-week moving average. Getting that deep below, you can see that was more than where we were in 2018, and about where we were, you know, 1 week left to go in the COVID drop. And again, if I were to go back out further, say out to like 1980, if you recall, that was a pretty deep level, you know, minus 11.79. That low point, you can see, I mean, that typically set the low point, even if we didn't necessarily stay. These were, you know, this was a bear market low, right? And that was a bear market low. So here's the correction, the low point in that bear market phase, and here's the correction low point in that bear market phase. You can see we rallied there. So I believe we've washed out. I think this is the washout low point. I just don't think that it's actually, we might actually get, I might have to move those zeros down closer to the 200-week moving average by the time we're done. If we were to break back through these lines and break back above the 8, and especially the 17, by the time the 8, you know, the MACD of the 817 crosses back up above its moving average, then we're going to feel really good about both. See, we might be in convergence mode for a while. When the MACD crosses above, the MACD might cross above its moving average next week. We're still well below the 17-week. So we might be in convergence mode for a while, which means we might still drop to these zeros, if not a little lower. I just don't think we're going to drop sharply. Remember, I've told you before that I believe the days of 2 and 3%, especially 3% declines, we've had 6 of them, like, I think they're done. They know getting 2% drops or more in a row, I think we're done with that, right? We didn't even get that in the COVID decline. And that's how significant of a washout move I believe that was. And I do believe, even though that move didn't necessarily produce a big, you know, there's your 3 2% drops in a row. We didn't even get above 100%. The VIX didn't get above 100% above VIX 3M because, you know, again, all the bearishness is in the long-term options, right? These, you know, it did get up to 34. That's a really high level. In the past, when the VIX 3M has been, not in the recent past, but in previous years, previous corrections, when the VIX 3M has been up to 34, the VIX itself is way up above 34. So, you know, the VIX right now is really, really low. We've talked about that a lot. Again, I also tweeted that about that. Your VIX, your volatility of the VIX is really low. I know it's not. It's really low compared to where we were the last couple of years, but it's actually also pretty low compared to prior times too. Like we've seen these lows. I mean, there's your early 2018 pullback, and there's your late 2018 correction. So we actually hit lows near 85 before those started. And obviously there's your COVID. We hit 85 there too. We've only been below 85 on the VVIX when we've been in strong bullish trends. Obviously we're not in strong bullish trends. So the fact that we're at this level now is a suggestion that this might be a low point. Remember, the correlation is also really low right now. I tweeted that out too. Let me bring that up. The correlation between the VIX and the VVIX right here, whoops, not that one, this one is also really low too, right? So it's down, below 40%, which is, it's rarely below 60%, much less like 75%. So it's usually above 80, to between 80 and 100%. So it's usually very positively correlated to the VIX itself. And so my thought is if this corrects, which means they'll both start moving in the same direction, and the VVIX is really low, so the direction that the VVIX is most likely bound to go is up, then that means the VIX will probably go up too, if the correlation corrects. And so, that means my expectation is that we'll probably get a move higher in the VIX off of what would be a higher low point, kind of breaking out of this consolidation up to this 105, 110% area. Again, by the time we finally finish this correction, like the March 2008 low point, we're kind of washed out in January 2008, but then we retested it by March 2008. Then that was the correction low, and then we had a couple of months of rally. So that's kind of the move I'm expecting that we'll get. Most likely by, I think we'll be starting that move by the time we get to July expiration, and we'll most likely be there by the end of the month. Really quickly, the range, I wanted to show you this chart. Today's move, we had a higher high and a higher low. We actually closed up above yesterday's high. We're still not above the midpoint. Getting above the midpoint will be a big deal. Getting above 390 will be and staying there. See, we kind of faked out there. If we get above 390 and stay there, we can really get going to the upside. So that will be what, again, tells me that this is the correction low point and we're moving. But barring that, I expect that we'll probably break this low point first from last week's low. I don't know if we'll do it tomorrow, but you can see we were just there on Tuesday. So if we were to break that low point, I expect that we'll break that low point first, and we'll still work our way down to the down to these lows. I believe that those were those there. We'll work our way down to those lows, and then maybe, just like I said, maybe a little bit lower towards 350. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. Tell me what charts or indicators that you're looking at that tell you why you're either a lot more bullish than I am or a lot more bearish than I am. All right, now let's shift over to what's driving this price action. And you can see, the big decline. This is a 3-month chart. So over the past, month or so, big decline in commodity prices. Gold as well, big rally in the dollar here. That's a pretty significant move in UUP, 7.5%. In fact, again, if I were to do a rate of change, so this is a 3-month rate of change on UUP. So this is the ETF that tracks the dollar. This is a tremendous move. I mean, go back to since basically in its existence since 2007. That's when it kind of started there. Started to pick up some volume over there. Like, here, let me zoom out. So here's where we're at. 8% over the last 3 months. 8%. 0.01%, but essentially 8%. So we got there at the end of 2016. We were at 8%, and that ended up being, we really dropped coming off of that point. At the end of 2014, we got up to 12%. Really sharp rally up to the upside on UUP, and you can see kind of where we're at now there compared to that. 2010, we got up right around 8%, got up to about 9%. At the end of 2008, at the very end of a big time financial crisis global market. During the washout phase of that market, it got up, was up over 15%. So prior to that, during a bear market low point, you know, while we were in the bear market started, remember, like in May. So there we got up to about 8%, and you can see the decline that it had. And again, this move here prompted QE2. This prompted QE1. This prompted QE2. This move over here prompted QE3. That move in the dollar. You can see that the Fed started raising rates over here, really started raising rates to the point to about 2018 is when they stopped raising rates. They started cutting rates over there. So you can see the dollar was actually pretty high once they started to raise rates at the end of 15, then started to kick in gear to a regular rate hike cycle in 16, and then by the time they finished the rate hike cycle, the dollar was still pretty high at the same levels as it was when you came off of the QE3 ending. And then you had this move up to 28, significant move on the dollar. You can see there, so we were at 27 over there at the financial crisis. So we got to 28 on COVID, so over 27, and that prompted QE4. And then now we're higher now. We're higher now than we were at the end of the Great Financial Crisis. We're higher now than we were at the end of during any point in COVID, right? This because we closed, the highest close there is 28.09, so we're at 28.58. Remember, this isn't a trending stock. This isn't like, oh, the dollar will just trend higher forever and just go up to 100 eventually. No, this isn't. This is a cyclical, because there's other currencies involved. There's 6 other currencies involved, and generally when the dollar is really bullish, those other currencies are really weak. And it starts to rally, it starts to move higher. You can already see the divergence high points. So we actually did get here at this peak in May, we got up to a 9.5 point run. And then you can see the divergent. We're obviously way higher now than we were then. Last couple of days, the dollar's really taken off. But obviously we're at a lower low point right now. If you take a look at the dollar versus the yen, you know, again, 16 we got up to, we were about a 16, 17%. We got up to 15%, where you can see we're already dropping. We're already back down below 10%. The financial crisis, at the end of the financial crisis, we were about 12.5% towards the end of that. So you can see, like, you know, the dollar's really bullish here. You know, have one of its biggest runs, but the biggest weakness for the dollar is against the euro. This is the lowest level the euro has been to. I mean, look at these past 2 days, getting all the way down to 101. I mean, it is making its way to parity. If you take a look at, you know, it's been the parity before, so this is nothing new. It was actually below parity during this bear market, right? This is the bear market of 2000, and we were already dropping going into that bear market. The bear markets, the correction started early 2001, and this is about when the bear market started, and it ended. The bear market ended over here in March of 03. The euro had already started to rally against the dollar before that, at the end of 2002. But for most of that bear market, the dollar was below par, was that stronger than the euro. So it appears that we're kind of moving in the same direction, down 7.5%. I mean, we've been lower than 7.5% before on the euro. If I were to do this at 7.5, so you can see the line there. We've been at 7.5% before, 7.5% there's 2014, 15. We were actually down 15%. The euro really fell off a cliff there. It was down 7% initially on those initial drops. 7.5% on all these other drops over here, and then you can see the great financial crisis. The dollar rallied really strongly. The euro was down 20%. Remember, there's all these talks of the euro breaking up, and it was always really weak for the euro, but at least it was above parity, right? It was, you know, we were hitting lows at 120, 125, and now we're back to parity again. So the, you know, the dollar is, you know, having a really significant outsized move right now. And there's the run. If I were to do this on the weekly chart, you know, again, you see just how bearish we are, how bearish that MACD is. Again, one of the lowest levels that it's seen. If I were to go out to 20 years, you can see again, there's your great financial crisis. The MACD got to lower levels. There's that 14-15 area also got to lower levels. And the same thing with 2010 that prompted QE2. We got to lower levels down there too. So, the momentum, it's been more gradual than some of these big sharp declines have been. But if I were to change this to show, okay, well, how far below like the 17-week moving average we are, it's pretty low, relative to what, there's only been a handful of other times that we've been lower. And if I were to go to where we are relative to the 200-week moving average, we're 10% below now. So we've hit double digits. And that in the past has been, absent the sharp decline there, in the past that's been about as low as we got. Like, we didn't get that low below the 200 week in 2008, 2009. We did in 2010, right about 10%, and we did again in 2012. Again, that prompted QE3. So this prompted QE3, this prompted QE1, this prompted QE2. You can see the moves here. This, we had the COVID. This prompted COVID. The COVID drop, the QE4, I guess you could say, and then now here's where we're at, and the Fed's actually raising rates instead of considering dropping them. So we are considerably below the 200-week moving average, to say the least, and it's continuing, right? We just have a very strong move right now. If you look at it here on this basis, you can see the divergence potential on the weekly chart, but you also on the daily chart. But you can see, depending upon how we finish the day, we may have a cluster to the upside with the market sentiment line. The last one we had was over here in 2019, and that was right before the Fed started cutting rates. That was right before the mid-cycle adjustment in the middle of 2019. We got a cluster there. We got a few clusters over there, but market sentiment was really low. And then if I were to go back out here, let's go maximum available. There's a few other clusters we got. None of them included the market sentiment line because the market sentiment took a while to get up there. We had already peaked by the time market sentiment got there. There's another one there too, where market sentiment was actually in the lower reversal zone. So for the market sentiment line to be here, it's pretty rare. And especially, you look back in April of 2019, you compare the moves we're getting right now, like on the DMI for an example. Now you can see the ADX. So here's the April of 2019 when we got that cluster. So it's been over here. You can see we are pretty bullish. Like the ADX was low. We did get relatively low on the negative and pretty high, above 35 on the positive. We're above 40 in the positive right now. The week's not over with. We're below 10 on the negative. The ADX is above 45, and we're getting a cluster with the market sentiment line. So needless to say that the dollar here may very well be going so parabolic that we might be kind of getting a blow off top type move. This is a tremendous move to the upside. And if I were to show you, so that you can see today's volume was more than 1.5 times on a daily basis. If I were to go out to a weekly chart, again, we have 2 days left in the week. You can see the volume has been really bullish. We still have 2 days left in the week here to see what kind of volume we get by the end of the day. But that big gap on a parabolic move, when you get a gap to the upside on a parabolic move, that has a lot of potential to be a kind of an exhaustion gap is what those are called. Especially, like I said, with the volume being above average yesterday and more than 1.5 times average today, and we'll see what it ends up being tomorrow. So again, how's the dollar been relative to equities? The correlation, if I were to remove all, and bring up the correlation to the S&P 500. If I were to zoom out here, so we can see some perspective, you can see, generally speaking, the dollar is inversely correlated to the S&P. So the dollar's been rallying for most of this year as the S&P's been bearish. And so if this correlation were to return back to zero, then with a sharp drop in the dollar, you would expect that would be bullish for equities. One thing to consider on that, though, is the dollar Japanese yen, which I don't know if it's not, it doesn't look like it's going to set me up very well for a correlation chart here, does it? If the dollar were to drop here, that's actually, let's see if I can, let me see if maybe a longer time frame will do it. Or let's see, maybe if we do SPY instead. No, so it's not going to, for some odd reason, it just won't let me do it on the yen currency pair. Here, let's do that. Okay. So here is the yen currency pair itself. So this is the yen relative to the stock market down there at the bottom. You can see the correlation is pretty positive. Now, generally speaking, it's not. Generally speaking, the correlation is pretty negative because the yen's a safety trade. So when risk appetite is high, then there's not very much demand for the yen. When risk appetite is low, then there is. That hasn't been the case this year. The yen's been extremely bearish and really gone parabolic relative to, again, last year when the markets were pretty bullish and the yen was declining. So, you know, again, that's your typical relationship, and that's not the case now. And so if this were to turn back up with this to roll over back to its normal levels below zero, then you would expect that to mean that risk appetite, risk aversion will be more in demand than risk appetite. So something to keep in mind when we're the other risk trade too that we've been kind of keeping an eye on pretty closely here for a while is the bond market. You got this pretty decent engulfing pattern. We just engulfed 3 candles there today. The MACD and histogram are peaking. We might, you know, we had just barely broke up above the 50. If you look at IEF, which is a 7 to 10 year bond, we're still actually above all these lines, but still you got the engulfing pattern there with the same MACD pattern. So we might be slowing down here. We kind of got this breakout pattern on bonds, but and the MACD did get positive barely. You know, it's been more positive in the past. This is hardly like a high level. So you can see where the MACD is if I were to change this line right here to what, 0.4 is where we're at right now. Let's try this again. So there's where we're at right now. You can see like we've had MACDs when we're bullish get higher than that. You can see some over here. You can see like really bullish during COVID, and this is during 2019. You know, this is a relative scale, so this is a normalized scale, so you can compare it across. So it's not like we just got like the MACD can still go higher, especially considering the MACD is typically cyclical and it can, you know, we were at very, very low levels for bonds, so you would expect that we'll come off of this and get up to the 2%, you know, move or higher to the upside. So, which would make sense if we were to fill in this gap between the 50 and 200-day moving averages where there's very little volume to begin with. So this may just be a short-term little deal. If we break back below these moving averages, then bonds can, that's going to be a sign of risk appetite. But if we stay bullish and the yen rolls over and that correlation, the yen bounces back up and the correlation to stocks rolls over, then again you can see how we might be bearish here going into, like, you can see how going into the end of the month that the risk aversion trade could finally finish. Like this can rally along where it hasn't been rallying for most of this correction. The risk aversion trade might actually start to rally here before this correction is finally over with. One last thing, let's take a look at the sector moves here today. There we go. Take a look at the sector moves and just look at today alone first. So July 6th, there we go. So energy stocks were really down. They were down 4.5% this morning. Just really getting hammered. They ended up being down 1.75%, but they're getting beat up right now. And energy stocks, just in general, have been pretty bullish. Bearish, excuse me. One other thing I brought up with the energy stocks, it's not too common for. Excuse me. Sorry, not this one. It'd be. Up here. So the crude oil is down 20% in the last 20 days. That's not, I mean, there's been a lot of talk about that, but that's not like uncommon. In fact, we've had three 20% declines in 20 days. And then we've rallied both those times. Like crude oil made a strong move there, crude oil made a strong move there. And if you look at energy stocks, you know, as bullish as they are right now, energy stocks, you know, as bearish as they are, they're down a lot because they rallied so much. They're just down the Fibonacci support, a little bit of a divergent low point forming, especially considering how far below the 200 week or day whole moving average. 20% below is very, very far. I expect that at best, you know, we rally again. At worst, we kind of go sideways like this, you know, and we get closer to the 200-day hull as it falls. But we probably start to find a layer here of support here between 65 and 70, and then work our way back up towards you know, 70, 75, 77 to see if you get back above that 23%, you're back on a bullish move. I don't think it'll be as fast as what we've seen before, but you know, I still think that we're not done. The commodities and commodity stocks, you know, this isn't the peak. Remember, commodities and commodity stocks typically peak, you know, after correction phases of bear market cycles, after the corrections are over with, and after, well, sometimes well after the recession has already started. So whether or not the recession started is a point of debate. We won't know until the NBER comes back in and says. But what we do know is we don't think we're done with this correction phase. So typically commodities peak during the correction bounce that comes off of that correction low point. Before I traded the other day, I want to take a look at Walmart. Walmart had really come off with its earnings and Target's earnings and inventory issues, and a lot of these retailers really had a hard go of being down 20% below its moving average, and now it's gone all the way up to being above 1.5% above. And the intermediate line, which got way down below the 5th percentile, which is so rare for the intermediate line to do that close again there, is now not only above its market sentiment line, but it's close to crossing out of bearish territory. So bullish near-term, short-term sentiment, coming off of a higher near-term low point, potentially moving up to a higher near-term high. So things are looking pretty decent for Walmart from that perspective. When you look at the 3 green arrows, we got 3 green arrows now, so we have green shade. We had briefly the red arrow right there that kept us from getting green shading until now. So the stochastics has turned up now with the stock above the moving average and the MACD positive. So we have our 3 green arrow signal on Walmart. You can see we're above all these moving averages. The MACD is about to turn positive. Actually has it's almost there. We're above the 17-day moving average, which we have been kind of flirting with getting above and below. So we've been in convergence mode for a very long time. That's why we haven't been dropping anymore. We've been in convergence mode here. We just haven't been able to get into bullish divergence mode. But that might be the case now, considering that we got above the 17-day easily yesterday, and now holding that follow through today with the stochastics turning up inside bullish territory. You can see some of the other indicators starting to move, at least getting out of bearish territory. The positive indicator had been so bearish. It's turning up. It's above its negative indicator now. If you look at the RSI and the CCI, they're both out of bullish territory as well, working their way up towards out of bearish territory, working their way up to bullish territory. From an Ichimoku cloud perspective, we're up above that blue line and staying so far, and the bearish trend that we had now is officially over with, as both lines have hit 0 there. Looking at the Arun indicator, there's the Arun indicator for the Walmart. You see the break to 100 with the after we dropped below 70 on the red line, it got to 0 on the green line, and then now the break above 100. So we got a new 4-week high point, a good bullish opportunity for this. The problem is when you look at the Bollinger Bands and the volume profile, we got a heavy resistance level up here at that 23% retracement level. So it's unlikely we're going to be able to break through and really get going to the upside. But we got a pretty decent gap in volume because of how far and how fast we fell, that we can get up to 135 pretty easily. So what I decided to do there was say, okay, well, let's take a look at the at buying a call option. Buying a at the money call option, the 125 call, setting a 50% stop order, And so what that does is it gives me about a half my total risk if I were to let those calls go worthless is $1,200, a little bit more than my normal risk. But if I use a 50% stop order, I'll be out at about $600. But if we hit the 135, 136 area, then I'm getting $1,200 of reward. So I'm getting a 2-to-1 reward to risk ratio, and all I've got to do is touch it there. And you can see, you know, the probability of touching 135 is over 56%. So we got a high probability of touching in that area if we're able to maintain the bullish move that we have right now. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video down below, subscribe to our website at marketscholars.com for free. Follow me on Twitter for more content between the videos. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.